going to talk about U.S. stocks.
Stocks, the dam is broken. The dam of unrequited buying has been broken, but with global fundamentals deteriorating fast, how long will it last? There are a lot of contradictory signals in the market now. All depends on Q3 earnings, which start this week. And then the outlook is bleak. They're looking at down 4% year on year compared to up 26% year on year. How the market keeps going up in the face of that is beyond me, but this has been a crazy market for quite a long time. It's all a function of the global cash glut. Insider selling at Fortune 500 companies is at 20-year highs. What do they know that we don't? Trading volume is falling in up markets, rising in down markets. That's always a negative indicator. Bottom line, we may get a marginal new high driven by short covering, then another 7% down for the next 3 months. With interest rates this low, it just doesn't seem like the market wants to correct more than 7%. 7.8% is what we got in August. Next slide. So Bill, here's the S&P 500. We bought the 305, 310 bear put spread a couple of days ago. It's a bet that we don't move above 305 in this rally. Have I gone crazy? Did I blow it? What's your take on this chart?
I think you gave yourself enough room there, John, quite frankly. I mean, I'm looking for, it's got to go to roughly 301 to head back higher. I'm going to take a look at it right now, and I think we're kind of seeing some profit taking right now. So I think you're relatively safe. When's your expiration on that?
That's in November, so it's 22 trading days from now.
Yeah, I mean, look, to me, the momentum's higher, okay? The question is how much higher, okay? And, I'm looking at a very succinct price level, which is 3,007 on the SPX to basically indicate to us that we will go higher. I would want to see a close above that. And until then, that's resistance. So,
right.
I mean, you're probably safe.
Yeah, well, I think I was probably a bit early on that. Classic overconfidence after a run of 28 profitable trade alerts can happen to the best of us. I'm inclined to use the next dip in the market to get out of cost and then see if we do get an upside breakout, and then that's where your great short is. Of course, what I'd really love to do is buy a bigger dip, and we've been doing that every time we've had them, June, August, and September, and everyone has worked fabulously. So that would be my preference, is to buy the dips in a market that's still in a long-term uptrend. Shorting is always tricky on the best of days. Next slide. Dow average, almost identical. Next. Russell 2000 is the weakest of the bunch, and that's what you would expect on the eve of a recession, because it's small companies that take the biggest hits. And I, in fact, came out of my put spread on the 153, 156 for a profit. We opened very low this morning. I came out then. We're just getting, even with 2 days expiration, all you need is one bad day against you for this thing to go to 153, and then you're in damage control mode. So rather than that, I took the profit, I came out. Any other dips we get today, you probably want to do the same thing. And let's see where the IWM is now. It's up 42 cents on the day. So still got $1.20 to the lower strike, but we are getting very close. So next slide. NASDAQ also trying to break out and create a new uptrend. And notice how well this 200-day moving average has held up. It held up here. It held up back in June. We didn't get close to it in August. So you're seeing this 200-day support on virtually all the other equity charts. Next slide. VIX back in the dumps again. I think we got a low of 13 this morning. And what's really interesting here is this high failed to top that high. So this, I'm not sure this even has any relevance, but is that a head and shoulders top in the VIX? Bill Davis, what's your view?
Well, I think the problem right now is you just said it. I mean, it's down to all-time support level, which, quite frankly, I do expect to bounce in the VIX.
Yeah, you would think, which means a down market, which what I've been expecting too, but you can't fight the tape. So let's see if this rally lasts a day or two. My guess is we'll get a batch of profit taking on Friday because people will have a lot of profits on the week to realize, and we will start to get to overbought territory by Friday. More questions. Bonabelle is asking, what do you think about Bitcoin? Answer is we hate it, don't want to touch it. It's unanalyzable, and only the insiders are making money. Randy is asking, are you predicting a repeat of the fall going into the end of last year to close at the lows? No, I am not. A year ago, we were looking at 4 interest rate increases. To this year, we're looking at 1 or 2 more interest rate cuts. So it's nowhere near the same situation that we saw a year ago. And that's why I'm saying, the most we're going to get is a 7% sell-off compared to the 20% sell-off. And if anything, stocks will rise into the year end rather than fall. Okay. Here's another question from Helgi. Why are we trading IWM instead of the RUT? We'd pay less commissions to brokers. And the answer is there's more liquidity in the IWM. You have to remember that the combined buying power of the trade alert service is about $1 billion. And that's harder to do with smaller, illiquid ETFs, especially the options on those ETFs. And Rick is asking if this is a don't fight the Fed rally for investors, where else is there to go but stocks? And the answer is yes, it's a don't fight the Fed rally, but it's happening in the face of an oncoming recession. So it's not exactly a great investment opportunity. It's not exactly a chance to buy at the 2009 lows again. Okay, next slide, please. Microsoft continued its flat line, breaking out to almost a new high here. We're still trying to buy on every dip. You just are not getting the dips. It seems to be the market's #1 most favorite stock. So even a mini dip, I think we'll try to get back into, but not here. We'll do it next time you get a generalized market sell-off. Next slide. Facebook, and I have a Facebook question here. Do you want to buy Facebook even though there is so many threats of government scrutiny and antitrust breakups? And the answer is the antitrust breakups are never going to happen. The government can't even define what Facebook's business is. There may be more requirements on disclosures. That means nothing because nobody really cares about disclosures. They just click the box and say yes to everything. And I actually was looking at this as a buy when we were in the big sell-off at the beginning of the month. So, and instead I bought 4 other tech stocks, and then this would have moved too far by the time I got around to it. So yeah, I think there's upside potential for Facebook, especially if we can break out from this current range. Next slide. Apple, yeah, you gotta love Apple, new all-time high. We were in it, came out at the max profit last week, looking to buy on a dip. This is becoming a 5G chip play for 2020, and that's when Apple brings out its first 5G phones. Next slide. Alphabet, also, we took profits on our long there, the 1030, 1080 bull call spread, looking for another dip to get back in. Also, you can see how well this 200-day moving average is held up there. Next slide. Amazon just crawling off the bottom. This is one of the companies that actually does have an antitrust risk, but again, don't expect any action. Congress would have to pass a new law for this company to worry, and that's never going to happen. So we're buying this on every dip, and it paid off this time. It'll pay off again. Next slide. PayPal, also fintech. We're looking to buy this on any dips, and could go up 30% to reach its old highs. Next slide. NVIDIA, semis going crazy over the prospect of a China trade deal. It's the chip stocks that have the largest amount of business in China and therefore the greatest exposure. Long term, we think all of the semis have doubles in them, so it's just a question of how to get in at a decent price. Next slide. Micron Technology is the same. It's also recovering off the bottom. Next. Salesforce, been flatlining all year. Really don't know why, but we're going to stand aside for the time being. Next. Boeing just can't get a break, and now the stock is looking expensive, especially if they can't get their 737 MAX off the ground. So I want to avoid this and wait for another revisit to 325. Next. Disney seems to be a victim of the coming streaming wars, where all of the major companies are pouring into the market at the same time. There is no other explanation for the stock to behave this poorly, other than the fact that the summer theme park season is over. Next. Adobe, been in a downtrend lately. We have played from the long side, took profits. I'm going to stand aside for now. Next. Industrials, getting a dead cat bounce on short covering. Do not bet your pension fund on industrials. They've been in recession for 2 years, essentially, and I don't see them coming out anytime soon. Next. US Steel, the poster boy for how bad industrials have done, and it's hardly bouncing, even though the rest of the sector is. Next. Walmart, put on another short. It may keep climbing, but not so fast that we get triggered on our new 125, 130 bear put spread. And we took profits on the 119, 121 last week. So that really should be shaded green. And I will get back to it. Next slide. By the way, we played Walmart both on the long side and the short side, made money every time. Macy's isn't bouncing much, but this thing is just so low that I'm not inclined to chase a short down here. Last time we had a short on this was at the 22 level. Next. Tesla seems to be doing well, trying to break out from a 6-month range. And again, production is increasing, sales increasing, and they still are able to get premium prices for their cars with all the add-ons. So long time 10 bagger in this one. We've been sort of chopping around sideways for 3 years. Next. Southwest recovering with the rest of the market. Next. Delta Airlines doing the same thing. Next. Transports also recovering as part of the general market move. Next. Healthcare really been a leading sector, and I couldn't have timed the launch of my biotech letter any better. The whole sector has been on fire. It's been really one of the top performing sectors in the entire this month, and will continue to do so over the long term. That's why we're in it. Next. Goldman Sachs doing awful, terrible earnings, terrible M&A business, don't want to touch. Next. Palo Alto Networks, trying to set a bottom here. I'd be a buyer at these levels. Next. Consumer discretionaries, also following the market, but don't want to chase up here. Next. Europe hedge equity, a big pop on the recent dollar weakness. And this does look like it wants to break out. Next. Japan getting the same sort of thing. You know, any kind of trade improvement is great for Japan, and that's why markets are rallying there. Next. Emerging markets, you know, the most hated sector of the last 2 years, even they are starting to recover.
I hope all of you found this helpful, and hopefully it has also improved your trading. This is John Thomas, the Mad Hedge Fund Trader, signing off for today. Good luck and good trading.